Hello guys, hope you are well. This is your boy Crypto Kib again, and today I want us to discuss about market structure. It is said that understanding market structure means understanding how to take a trade, a profitable one at that. And all you need to know, the main thing you need to know in trading, making a successful trade is market structure. Market structure is very, very important in order for us to understand how the market reacts and which way the market is going. You know market structure, you know everything you need to know. No matter the strategy you trade, no matter the indicator you use, you need market structure to understand which direction the market is going to go, or which direction the market is currently going, or if the market is, let me say, bullish or bearish, or is consolidating, which means sideways, or if the market is about to reverse or is reversing. So basically, market structure is similar to trends. When we talk of trends, either uptrend or downtrend, is similar to market structure when we talk of bullish structure or bearish structure. They are basically the same thing, but the use of trend lines is quite different and the use of pattern is quite different. I don't think a short video will be able to cover everything I would like to impart into you today, so I may divide this video into maybe 2 or 3 short videos, whichever comes first. So market structure is a series of higher highs and higher lows, and also a series of lower lows and lower highs. One is bullish, one is bearish. Just like we have the trends, we have an uptrend and we have a downtrend, which the uptrend is a series of higher highs and higher lows, and then the downtrend is a series of lower lows and lower highs. I will take them as the same thing. So when we talk of market structures, this is what we are saying. We have a low, an high, an higher low, an higher high. Then that is a bullish structure. Then we have an high to a low. Then we have a lower high to a lower low. That is a bearish market structure. That is all you need to see. But apply market structure is the logical part, because seeing these patterns is also a pattern here. Seeing this pattern, because if some people may take a trend line and rule, then doing this, it becomes a pattern. That's a bearish flag. But that is not the topic yet. So seeing these patterns, the application of it matters a lot, because many people may misquote it or misunderstand it, so they apply it wrongly. So how does market structure occur, or what makes it to occur? I will be giving this example in this very lesson. Now, there is one thing I'd like to say before I continue. I want you to understand that scarcity drives demand. Scarcity drives demand. And in turn, demand drives price up. Whereas excess or surplus drives supply. And supply drives the price down. You should understand this. Scarcity, when there is scarcity and there is demand, it drives demand. If the commodity we're talking about, or the asset, is in high demand, when there is scarcity for it and the demand comes, it drives the price up. But when there is excess of items or excess of commodity, demand will surely meet supply. And when demand dries out and there is the excess of this commodity, it will drive down the price. Okay, let's take an example of a seasonal item, seasonal product, like maybe some food stuff, maybe cucumber, eggplant, beans, something that comes out like yearly, not that is always available, or something like cherry. Sherry comes out at a particular time of the year, and once that time is off, you do not see sherry on the street or some other products. Let's take an example of that. So let's assume that every year, like in May of every year, we have a supply of an item comes in excess. There is availability of it everywhere. And by the time it gets to December, by the time it gets to December, that supply is gone. You can't find it anywhere except people who have stocked this somewhere and selling. So what happens? Let's assume that this point here, this very point here, let's assume that is December. Let's take this to be December. December of a year, let's say maybe December 2020, which means the stock is going out. People are going out of stock. The item being sold is going out of stock. And if there is demand on that item, what do you think will happen? People will start buying at any amount the seller offers to sell. Thereby, we see an increase in the price. If maybe there are 10 items available and there are 20 buyers, the sellers will increase price to make more money. Just like I discussed in the last video on candlesticks. So the sellers will increase price to take advantage of the situation, of the demand that is coming in, whereas this item are going out of stock. So they will keep increasing the price of this item. And because it is a necessity for you to have, or maybe you have the demand for that item, it could be anything. Because you have the demand for that item, you will be willing to buy at any amount, because when it gets to January of the next year, you won't be able to find it anywhere anymore until May. So they drive the price up slowly, maybe from November, December, January, up to the extent where there is excess again, where there is, let's say this is May now. May is when the item come back to town in excess. So when you have excess, what happens? If people will still be in need of this item because it is yearly, let's assume it's an item that is always in demand, always in need. So people will buy when you have excess or when there is scarcity. But what happens when there is excess supply? Demand remains supply. The price has gone up. The price has gone up from December up until somewhere around April, May. Then what happens? You see maybe the price come down, fluctuate, make it sideways, because demand is meeting supply. So you see this sideways structure because there is no much. People are not willing to reduce the price, but people are also not willing to buy higher, because if a seller quotes you higher amounts, you usually walk away and meet another seller to buy. So you see a kind of equal demand to supply. So the price is kind of stable, not moving up, not moving down. Somebody can reduce price for you to sell before the other seller gets his or her own sold, and the seller won't also quote you higher price so you can buy. So you see a bit of sideways action. But then what happens when there are no more demand? There is no more demand. People are no longer willing to buy. Maybe the moment it first came out, the first month of May, people has bought everything they wanted, and then the demand is very low now. And something being a perishable item, sellers won't like to hold on to it for so long, knowing in the next 6 months it will be out. So it's better for them to sell now than keep what may end up getting spoiled. So what you see is that the price starts to decline. The price starts to decline due to the excess demand. All buyers have bought, then you see a slight decrease in price. And as we know, price of commodities in this part of the world goes high or goes up very fast. But when it comes to reducing the price of items, because there is excess of it and no more buyers, people will start selling at cheaper prices for whoever is willing to buy, so they can buy, so they don't hold on to what is no longer wanted. So but the price doesn't decrease. It doesn't go down as fast as the price increases. You see a slow bleeding on it. So it gets back to December here where there is scarcity. Also, if some sellers are able to stock it and preserve it, what will happen? Anybody needing this product by December again of the next year, you see the sellers start to increase price again. You see the sellers start to increase price. This December to May is a period of 6 months, and this May to December is a period of 6 months. So you know every 6 months this product is likely to go out, and in the next 6 months it's likely to come in excess. So that is what drives the price up or down. And we know price doesn't fall as fast as it increases. People are willing to add money on top of your order, but they're not willing to reduce much when there is excess supply, except there is a bad news or something. So that is why what causes the bullish structure. So some people now may be expecting these points in May. Now, okay, when prices get back here, it's going to fall based on those who trade support and resistance. But that is another topic for another time. So seeing this structure, the low, the high, the higher low, the higher high, what do we expect when it gets back to May? When May comes again, what do we expect? We expect maybe a sideways, then we expect the price to start decreasing again. Now, support and resistance traders, we believe this point is where the price will reach before going back up. But nonetheless, we expect an higher low, lower than the December low. And then when December comes again, because they wouldn't reduce the price as fast as it has gone up, then we expect it to again go back to get increased as fast as they can again, creating another higher high. But what happens maybe when there is this bad news, like the government wants everybody to stop buying the item, maybe there is a poison in it, or the batch being produced at that particular moment is killing people, then will become sad news. So at this point in May, when there is a bad news, or when people think the price is getting too high, they can no longer afford to buy this particular item, they tend to find alternatives. When they get alternatives, or when there is a bad news, the price will crash because nobody is buying it, either due to bad news, the government wants that this product is killing people and they don't want people to buy it, or people think it's too expensive for them to buy at this particular amount and they start looking for alternative. For example, people buying Gary, maybe they think Gary is becoming too expensive, then they start buying Semovita. They stop buying Gary entirely to buy Semovita until the price of Gary drops. So when such thing happens, we see sellers reducing the price so fast. We see the sellers reducing the price so fast that it can come down as fast as it's cool. They want to sell quickly to the willing buyers, little or not little. They want to sell quickly, so they do not hold on to something that they will lose on. They don't want to lose. So they are willing to sell at a cheaper amount so that they can recoup their capital or lose a bit of their capital and not hold on to something that will be worthless in the next 6 months when there won't even be any supply at all, and then they will be holding on to losers. So they will reduce price. And what are we waiting to see to know that, oh, the price is going to come down? The price may come down up to a higher level, higher low, then goes back maybe the next May. This will be December. Sorry about that. This will be December. If it comes as it forms an higher low to the previous December, then when May comes again, due to people are still not buying, we have alternative now. It wouldn't go beyond the highest price it has made in May when the bad news came out or when people stopped buying. So you may then see them again, people who have bought, or maybe if they produce, maybe they have farms that produces such items, and there is badness on it, it won't make them stop going whatever they go, only that they will reduce the price at which they sell. So now they will start reducing the price again, then you see it go even further lower than the amount it has gone in the previous months. Then you see it go beyond the amount it has gone in previous months. When you see this low being taken out, then you know that the market is reversing. When this low, this last low leading to an higher high, is taken out, then you know the market is reversing. Either way, from this very high, it can come even lower than the December low. Because you know, when there is a sell-off in the market, like we've seen on Bitcoin and some other odds, when there is a bad news or there is a negative news somewhere, the way it crashes is just so fast that it breaks the structure. So once we see this last low, the lowest low, the last low the price made here in December, once we see it taken out and then closes below it, I will look for a minimum of 2 closes personally. Yours can be once, you may not even wait, it may just be a week or shadow. The filters depends on you. So when you see this low being broken, what do you expect? You expect it not to go above the high, but to create a lower high, and then what next? Creates a lower low, lower than this very high. Once you see this, then the market has done what? The market has reversed. So that is how the reversal occurs in market structure, and that is the market structure. Series of higher highs, like this higher highs, so let me connect them, this highs, and then lower highs like we have here, then series of lower highs like we have here, and then lower lows like we have there. Looking at this, you can see, we can say from here, from this point, sorry, we can say the market is in an uptrend. Why at this other point, from this May down here, the market is in a downtrend. Here we have a bullish structure, here we have a bearish structure, which is an uptrend, a downtrend. So that is why I said market structure is basically the same thing as trends, either uptrend or downtrend. But talking about trend line, that is another thing, because when you see this trend line, will you use this trend line as an indication for early break of structure, or will you wait for the structure itself to be broken before you say the market is reversing? Some people will take this trend line. Let me clear this chart first. Let's assume we have a low here, an high, then an higher high. Yeah. Then we connect the trend line below like this. Some people will say once this trend line is broken, then the market is reversing. And we might have something like this. Something like this with a close. Now you trading this, maybe with trend line, will you say this market has reversed? Personally, I won't say it has reversed until I see this low being taken out. Once I see this low being taken out, I want to see this low. Let me make it bold a bit. Okay. Until I see this low being taken out before I will say the market is reversing, because we can have this high, then the trend line breaks for it, yeah. Then from this low, it comes back into it, then do a reclaim of it. And then, and then from the low, creates an higher high again. Or it might not even work in that pattern. You may just break the trend line, then from there go up again like this. Resumption of the market structure, the bullish structure. So you see, breaking of the trend line doesn't necessarily equate that the market has reversed. It is an indication that the market may likely be reversing. Once you see a break of this, you can see another move like this, maybe a retest of the trend line, then a retest of this low, I don't know why this thing is not clicking. Then a retest of this low, either go up, but if it breaks and closes below, then the market has reversed. So you must always watch, always watch for the low leading to the higher high, or the high leading to the lower low. This may be the high leading to the lower low, but there is another filter I will talk about in the part 2 of this video. But basically, we have known what is market structure. So let's stop here for this first video. Then the next video, I will talk with explanation, identifying reversals, and then knowing if a swing I has fully corrected or is not yet done moving up. Like what I'm trying to say is, we might have this structure like this. Let me remove this. Okay, we have this higher high, this higher high. Then we have a reversal from this side up to this extent. And then what we see is a move up. Is this a good correction for this move, for us to take this low as a valid low leading to this high? Or is this move from here to here one? Like from here to here, is it one? Or is this a valid swing low for us to use in a market structure? Because if you do not know these things, you can easily mistake them and trade them, then you lose. But you have to make your rules straight. When your rules are straight, which means you want to take only the best trade, you may lose trades. Yes, this may work out like this. Yes, another thing, you may be looking for it to correct up to this extent, and it will never do that. But correct to this extent and keeps going up, then comes back into it and keeps going up. But then when you set yourself a strict filter to filter out bad trades, you only want to take the best quality trades, which means you have lower probability of losing and high probability of winning. But when you see a setup that is not so good, but you take it, you may have an higher probability of losing and a lower probability of winning, which is not always the best. So in the part 2 of this video, I will talk about filters I use personally to watch out if the market is not correcting or if the market is reversing. And what I like to see, I will use a sample of this chart and some other chart also. So that is basically market structure: bullish scenario, bearish scenario, then the uptrend and the downtrend, which is basically the same thing. But you can also call the market structure the price structure, because it is the price, is the structure the price is printing for you to know what is going on in the market. Once you know that, you know your direction. Some people use maybe moving averages, but you can do everything without those indicators. So in the next video, I will explain in detail how to look at those. Thank you for watching. I expect the part 2 shortly.